This is the most famous entry pattern in all of ICT. Sweep the liquidity, wait for displacement. Enter on the fair value gap. Every guru teaches it. There are millions of views explaining it. So we did the thing none of those videos do. We wrote it into code exactly as taught and tested every single time it fired across the NASDAQ, the S&P, and the Dow on 3 timeframes, 300 setups, 0 discretion, real data, conservative rules. It lost money. And before you type skill issue, we didn't stop there. We tested roughly 1,000 ways to fix it and watched almost every fix die too. What's left standing at the end is worth more than any win rate screenshot on this platform. Here's everything, including the parts that make us look bad. First, the pattern itself on a real trade. This is the NASDAQ June 8th, played back from raw 1-minute data. Price runs above this old high, that's the sweep. Stops get taken, liquidity changes hands, then this. A violent move down that leaves a gap between candle 1's low and candle 3's high. That's displacement, and that gap is the fair value gap. The theory says price comes back to rebalance the gap before continuing. So the entry is a limit order at the midpoint. Consequent encroachment, stop beyond the swept high, target at the opposing liquidity. Watch, filled at 29,722, and 4 minutes later it's paid 2 to 1. When it works, it looks like cheating. The question nobody answers with data: how often does it work? The rules so you can audit us. Detection is mechanical, a sweep of a meaningful prior high or low, displacement the other way, a gap bigger than noise, 5 points minimum on NQ. Entry, limit at the gap's midpoint, first touch. Stop. Beyond the sweep or the gap fails on a closing basis. Target, the nearest opposing swing. Every trade scored conservatively. If one candle touched our stop and our target, we counted it a loss. If the fill candle also touched the target, no win awarded. Every tie goes against the system, so when something survives this scoring, it earned it. 8 sessions of 1-minute data, 81 filled trades, win rate 11%, net result negative, and at one point 16 losses in a row. Sit with that number. On a 50K prop account with a trailing drawdown, you are not alive after 16 straight losses on full risk. Maybe it's the time frame. We reran everything on 5-minute bars, a month of data, 57 more trades, 12%, negative again. Fine, 15-minute bars, 3.5 months, 72 sessions, 7.7%, 3 time frames, 3 independent samples, 1 answer. And here's the insult on top. 29% of valid setups never let you in at all. Price swept, displaced, left the gap, and ran straight to target without ever retracing. The textbook entry spends a third of its life watching the move it correctly predicted leave without it. This is what the standard loss looks like. May 19th, NASDAQ. Perfect trigger, limit resting at the midpoint. This candle fills us and blows through the stop. Same bar, filled and dead inside 5 minutes. Nothing about this trade violated the textbook. The textbook just doesn't tell you it happens 9 times out of 10, while you wait for the one monster that's supposed to pay for everything. On our 1-minute sample, the entire system's hope was a single 16R runner, 1 trade. That's not an edge, that's a lottery ticket with extra steps. So we started over with the most prop firm question possible. What if you stop swinging for home runs? Same entries, same stops, but take fixed profits, 1 to 1, 2 to 1. At 2 to 1, the all trades number goes from clearly losing to roughly break even. Better, not good. If a filter doesn't exist that separates the real ones from the traps, this is a commission donation machine. Turns out there are 2. We sorted every gap by size into thirds. The big, juicy, obvious gaps, the ones everyone screenshots, went 0 for 20 on the 1-minute data. Negative on 5-minute, negative on 15-minute, 3 for 3 the trap. The gaps that paid were the unremarkable middle. On the NASDAQ, roughly 8 to 19 points depending on time frame. Pair mid-sized gaps with the 2 to 1 exit, and the system goes positive on all 3 timeframes. Plus 0.08 R per trade on 1 minute, plus 0.11 on 5 minute, plus 0.20 on 15 minute across 3.5 months. We thought that was the finding. Hold that thought, because science is about to do what science does. Now watch how easy it is to fool yourself with a backtest, because we almost did on camera. In the 1-minute data, the lunch window, 11:30 to 1, was the best time of day for fixed exits. Then it showed up again on 5-minute, 39% win rate at 2 to 1, plus half an R per trade. 2 independent samples. Trades like this one, S&P June 3rd, sweep at 12:40, fill at 1:10, paid an hour later, while everyone who traded the open was already done losing for the day. We were ready to put trade lunch, skip the open in the thumbnail. Then the 15-minute data came in. Gone. Basically flat on the longest sample of the 3. 2 for 3 sounds good, until you remember that's exactly how every cherry-picked strategy on this platform gets born. So lunch goes in the interesting unproven pile, which raised an ugly question we couldn't unask. Our width filter survived 3 timeframes, but would it survive us actively trying to kill it? Here's the assassination attempt. Our gap size boundaries were computed from the trades that filled. Recompute them from every signal instead, and the boundaries move by 2 or 3 points. That's the whole change. 3 points. The width edge vanished, negative on all 3 timeframes. An edge that dies when a definition wiggles by 3 points was never an edge. It was noise wearing a lab coat, and it had us fooled for 2 weeks. While we were at it, we tested the most sacred rule in ICT: only trade with higher time frame bias. It made everything worse. On 5-minute data, setups that agreed with the hourly trend won 0% of the time. 0. Think about what this pattern actually is: a sweep and a violent reversal. It's a fade. Demanding trend alignment is asking a reversal pattern to stop being a reversal. The edge, what little there is, lives in the trades that fight the hourly trend. So after roughly 1,000 combinations tested and killed, exactly 1 configuration is left standing. Enter at the gap's edge, only counter to the hourly trend, take fixed 2 to 1. Positive on all 3 timeframes, under both scoring methods, 40 plus trades each. How positive? Plus 0.03 to plus 0.12 R per trade. That's the lone survivor. And after searching 1,000 cells, the lone survivor might just be the luckiest corpse in the graveyard. Now the part every other channel cuts. We searched roughly 1,000 filter combinations on the same 3.5 months of data, and at that scale, something always looks good by accident. Every finding in this video was discovered and scored on the same sample, no commissions, no slippage, 1 market regime. If a vendor showed you our lone survivor as proof of an edge, you should close the tab. And that's our number. The honest scoreboard, traded the way it's taught, the famous entry, lost on every time frame we tested, fixed 2 to 1 exits, dragged it to break even, and every clever filter we tried died under hostile testing except 1, which now has to face the only exam that counts. Data it has never seen. That's not a cliffhanger, that's the method. The highlight reel guys skip this step, and this step is the entire difference between research and marketing. Every one of the 300 trades in this video, entries, stops, exits, timestamps, is an JSON file you can download free in the Discord. Check our math. The indicator that draws these gaps live is linked below. Next video, the lone survivor takes its real exam. Years of data it has never seen, out of sample, no excuses, and then CISD gets the same treatment. We test. You decide. Subscribe if you want trading content that shows you the losses.